We are live. Here we go. Live on our show, D Financial Friday, across all our platforms. Welcome. My name is Alfred from DiversiFi Capital. We got Raymond joining us as well. It is Friday. It's another one of our shows. Raymond, how are you?
Doing good. Happy to be on the show again. It's already mid-March. This year is just flying by
Oh,
every single Friday.
yeah. We were just talking as a team. What looks like May 1st, maybe everyone has availability to get the vaccine. It's going to be
Yeah.
one hell of a July 4th party, maybe, right?
Hope
And
so.
so things are looking up, right? It's
Mhm.
supposed to rain over here this weekend, but it's sunny right now. And I think for us at least, springtime, get outside. Hopefully, days don't feel like just another day going forward. It certainly has felt that way lately. Hope you guys are all doing well. Again, welcome to the show. Welcome to the Financial Friday. What do we got going on for you? Well, we're going to be talking a little bit about market orders and how do you actually make some basic trades in your account. I think that's often been a confusion at times about when you walk into or you log into your brokerage account and you want to make a buy and a sell and you hover over the pull downs. You're like, what the heck's a limit order or a stop loss order? What is a good till cancel? So we're going to review all of that with you guys today, so you have a sense of how you actually can make trades yourself. What are the positives? What's the easiest way? And what are some things to look for? Because it may sound attractive, but it might not actually be what you want to do. Okay, so we're going to walk through that later in the show here. But of course, we're going to start off the show talking a little bit more about how the market has done. A couple of things, of course, to go over with you. And before we get started on all of that, just remember we are live every Friday at 3 p.m. So if you've enjoyed what we've been doing so far, hit the subscribe button, hit the like button, let us know what you guys are thinking. And of course, we'd be happy to tie that into our show. Of course, at the end of the day, we're coming to you live through our streams, which means that this isn't meant to be personalized financial advice. This is just general financial education for you guys. Hopefully starting to ask the right questions. And again, thinking about, in this case today, how to make some right trades in your account so that you can actually place the order that you want to. Okay. If you're looking for personalized financial advice, there's a place for that. DiversiFiCapital.com. Check out our Get Started page. It's a little video there of me talking about our services, how it's a little bit different than the most of the industry and how it's provided. So again, check us out over on our webpage. Anytime we talk about investments, just remember that, again, it's more for general investment education. And we're not trying to solicitate you to be buying any particular investment products. All right. Cool. So, right. Another week.
Yeah.
Markets rebounded, right? We had a little bit of a rebound here. So we're going to show on the screen in just a second how the market has done. But there we go at the bottom, right? Highlighting some numbers. But Raymond, give us a little bit of an update. What are we seeing right now? And what are you anticipating to be some changes that we could see in the next week or so?
Yeah. So we've definitely, as you mentioned, saw a rebound, right? With the numbers that you're looking at. S&P 500 at 2.65% up, Dow Jones at a whopping 4%
I
or
know.
more, that continue to do well this week. And even though NASDAQ did climb back to 3% to rebound from what we saw the past few weeks, still below Dow Jones, right? Definitely seeing the Dow Jones pull further away from the NASDAQ. And even year-to-date performance, S&P 500 is up about 5%, Dow Jones actually up 7% so far, and NASDAQ at about 3.25%.
I
So
think, did I see a headline there, Ray? Something like it's been since 2016 where Dow Jones would outperform NASDAQ 4 weeks in a row or something like that, right? And so
yeah,
what I'm saying is, right, Dow Jones has done well, as Raymond said, right? 7% this year versus 3% for NASDAQ. But right, on a week-to-week basis, there hasn't been a 4-week winning streak where Dow outperforms the NASDAQ since 2016. That's kind of wild, actually, when I saw that headline today. Kind of goes to show you how well growth in general has been doing. Right. And so what else? We got the markets, right? We got the stimulus plan, right? I mean, that went through.
Yeah,
right?
so we just had Biden sign yesterday the $1.9 trillion stimulus package,
Hmm.
basically to put more money into the economy directly to hopefully the American citizens through the stimulus checks, as
Yep.
well as continue to help small businesses that have been struggling during this pandemic, right? So some key things from this stimulus is going to be expecting about $1,400 in stimulus checks that people might be receiving as early as this weekend. So that should be coming up fairly quick. There's also going to be extension of federal payments towards underemployed or unemployed individuals, right? So
Mm.
that's going to continue as well. There's going to be some help towards child tax credits if you have children. It used to be $2,000 per child. They're actually going to increase that to as high as $3,600 per child, depending on their age. So
Yeah.
more help to the families there with children. And then, just as Biden mentioned, right, he wants to put it to the forefront in terms of getting those doses out. So adding another $160 billion to help states and local governments help distribute those doses. And as you mentioned, May 1st, right? He's trying to aim for a May 1st to have all states start to allow all adults to be eligible to start getting those vaccinations.
Yeah, that would be nice. It would be
It would
nice. A
be.
little step towards normality here. And I think that's probably why some of the certain parts of the market are doing well, right? If the
Mhm.
economy, the vaccine rolls out, does well, right? Stimulus does well, it's going to help the economy to reopen. So certain value sectors and we call it cyclical things that depend on how the economy is doing. Those sectors, I think, are starting to actually they're continuing to lead the market right now,
Mhm.
right? And so all while everyone is still watching the Federal Reserve and what they're going to talk about in terms of rates, right? And we've talked about that in our past couple shows, right? They're set to meet next Tuesday and Wednesday. Now, I don't know that they're expected to make any major changes, or, and in fact, most cases, it's what people are looking for from them is the tone of voice, the conversation. You're like they're basically dissecting word for word what they're
Yeah.
trying to say. Like, what are they trying to say about inflation? What are they trying to say about long term interest rates? Because that's going to be a little bit of a wild card here, right? If they say, hey, you know what? We are now seeing trends that inflation is going wild and rates are going to be going up to be able to counteract that, then I do think that something like the NASDAQ, which is kind of based off of growth and has an impact on where the interest rates are, that's going to get continually, performance wise of that index is going to continually be impacted, right? So, it's a good time to look at your portfolio and say, hey, like how much of these different areas am I exposed to? Am I just in S&P 500, or am I buying into these individual growth stocks because they've done so well for me? Right? Is it time to take some off the table? Those are going to be questions to be asking yourself going forward. Here is it still worth it to hold those positions?
Yeah.
Right?
I
And
think
so,
the thought process behind rates inflating is that for those companies that are relying on debt, right, to grow their company,
yep.
with those interest rates rising, it makes it more expensive for them to borrow, which overall impacts their growth, right, and their valuation because they're paying more for the debt now. So that's something that Alfred was just kind of mentioning there in terms of re-looking over your portfolio and just adjusting as needed. So
Yeah. So cool, right? I think otherwise, it was certainly nice to see a little bit of a rebound, but interesting to see how well, right, value, which is the Dow Jones, continues to outperform, right, the Nasdaq this year. And so a little bit of a role reversal from last year, where Nasdaq, drastically, okay, and then I mean drastically outperformed the Dow Jones. So things kind of return to normal sometimes, and statistics play a part of that to say return to norms, right? And so you're seeing that adjustment possibly, and here are some of the factors of why, right? Okay. So, we've been getting these questions a lot. And I think, to the shows that we've been doing, Raymond, I think part of it is what? More people are trying to trade, more people are trying to understand what it means to buy stocks. And, I probably would run across on a, day-to-day basis, like someone will just ask me, like, hey, like as I log into an account, what does it mean to have these type of orders? And certainly they don't make it that easy. I mean, you can of course like look it up and Google it and it's there,
sure.
but within, right, the platforms themselves, sometimes like it's a lot of money that you're trying. If I'm trying to
Yeah.
buy $5,000 into a position, I don't want to do it wrong, right? And so we're here today to talk about the most common stock trade orders that you can place in your account. Okay. And so, Raymond, lead us off, right? Like, what are some of the orders that you see, right? And then we can elaborate on how to use them. But just list off, like, if you go into account, what's the first type of order that you see?
Yeah, I mean the most common one, the first one that you'll see is going to be a market order in this
Hmm.
case. So it's definitely the most basic type of trade where, by you following the price or the movement of the stock, once you place the trade, it's basically going to execute and try to get the best price according to that time of when you placed it. So once again, this is definitely the more straightforward, market order during open hours during the market will get placed immediately and try to get the best price that you're asking for at that time.
Wow. So, what if I don't want to buy right now, right? But I have $5,000 and I want to buy in at a specific price, or right? We'll start with the buy side, right? I want to buy in at a specific price. What would I use?
Yeah, so you can use a limit order in that case if you had wanted to purchase a stock at a certain price. Once it hits that price, you'll be able to either purchase it at that best price, or it could be higher if you're trying to sell it, for example. But for a buy, if you're pricing it, you want to make sure you're pricing it below the current market price, right? Because you're hoping to buy at a lower price. And if it goes lower, it even works out better for you because you're buying it at a much significant lower price than the market currently. So
Yeah.
that's one way to set a price for yourself. And once it hits that limit, then we'll get that price that you had wanted for it.
Yep. And so in that case, right, in either one of those cases, right, you have a market order. Basically, you're saying, I'm looking at the market today. I like where it's at. I just want it to buy. Boom, you hit market order, right?
Correct.
Limit order, though, is going to be something, as you said, some price that some threshold that instead of buying at $100 today, I want to buy it at some other price. Okay. I want to wait for it to go to 95 before I buy. Okay, something like that. So if it hits 95, I buy. But that limit order, when you place it, it's going to ask you another question, right? It's going to ask you something that says good for the day or good until cancel. So what do those two terms mean?
Yeah, so good for the day just means that when you place that trade and that price that you're looking for, it's only going to work out for that day, right? So if using your example, Alfred, if we're trying to use, $95, if it hits $95, great, the trade gets placed at that point. However, let's say that stock never hits $95 that day, in which case, if it doesn't happen, it just automatically gets closed for that trade.
Mm.
So if you had wanted to do this again, you basically have to wait till the next day, create that trade again, whether you want to do it for good for the day or good until canceled, which basically means you can set a future date on how long you want this to hold on to, right? So instead of just having it for one day, it might be for a week, for example, where if over this duration of a week it does hit that $95 price that you specified, then it will still be considered a good trade at that point.
Yep. And I think that's probably what the most common thing that we see where someone wants to put a buy order in and they say, I want to, wait for it to get down to 95 before I buy. And then, they say good for the day, boom, click done. And then it hits 95. They're like, wait a minute, how come I don't have this stock in my account? And it's because a couple of days have passed and their good for the day order only lasted for that day, right? So if you want that to be an indefinite order, right? Or by the way, it can't necessarily always be indefinite. I think most good until cancel orders last like 12 months or some time period that your brokerage or account will set, right? But in that case, it will last until generally it's filled, right? And so this all works in reverse, right? So if you want to sell your shares, you could sell at a market order, right? Which is you're just selling at whatever best price it is currently. Or you could do a limit sell order, which is if the price is at 100, but you want to wait until 105 to sell, you would set a limit at 105. And at that point, when it hits, it would just trigger and sell. It guarantees that it's filled in most cases, right? But it's also potentially a disadvantage if markets are moving like very volatile, right? It might not, be quote unquote the best price. But if you've set the price at 105, likelihood is that it fills. When I say fills, it actually transacts at a very close price to that.
Yeah.
Right.
I mean, it depends too, like on stocks that have a lot of trading volume, right? People that are trading buys and sells, it's a lot easier to execute on your full amount as compared to maybe like penny stocks, right? Where it's a little bit
Yeah.
more crazy. Those are the ones that to be a little more careful about as compared
So,
to just normal stocks.
and tell our audience, when you say volume, right? What do you mean by that? What's the difference between
Yeah.
the volume of a penny stock versus the volume of Apple?
Yeah, so I mean, the volume is basically the amount of trades that take place that certain day. So be the number of buys, the number of sells that occurs. And how we look at volume is just trying to see, if it's towards their average volume trading, just showing that, hey, there's probably nothing important or nothing crazy going on with the stock that day. But for example, let's say that the average volume is 2 million trades that day, for example. Whereas maybe that day you're seeing it's 7 million trades. That means that there might have been some earnings that day, might have been some news around that stock occurring, more volume to be traded on that stock.
Got it. Got it.
Yeah.
Right. So, yeah. So you can exercise these orders, right, in either fashion, right? And so you definitely want to be understanding how these orders work, right, to actually get what you're intending. Okay. Because if you're intending to say, no matter what, I want to be able to, buy anytime this share hits 95, then you want to make sure it's a limit order right at 95. That is a good until cancel order, right? Because otherwise it's not going to be there, right, when it hits 95 potentially.
Yep.
Okay. Awesome. So now those are some of the basics, right? Market orders and limit orders. There are now something you can add to it. You can stack your orders or stack the conditions of your orders. And this is where it gets a little bit complex. And I'll tell you some stories about how clients have used these and have gotten some unexpected results. Okay. And so there's something called a stop order. Sometimes it's called a stop loss order. Okay.
Mhm.
And so uh, the stop order or stop loss order is an idea that you're creating a condition or a price in this case before the order becomes active, right? So what you're saying is, hey, you know what? I want to potentially buy this company at $95, right? Or I want to buy it at whatever price, but I want it to show some upward movement, right, before I actually trigger the price. So if the stock is at 100, okay, I want to put maybe a stop order or stop price at 105. So it's now showing upward movement. It hits 105, and then it would do whatever buy or sell, or sorry, a buy or limit order from there. So here's an example, right? Like you could say, I want to do a normal stop order, which means that once the price is triggered, it becomes a market order, like we said before. So you're just adding an additional condition there before it becomes active. Or you can say, I want to do a stop limit order, which is basically saying, I want the price to hit, and then the limit price, basically the limit orders become active. So it's another step, right? Another step that you're adding before your trade order is actually an active order that could get placed. Okay.
Mhm.
Now, it's basically a way for somebody to kind of execute on a strategy that they may want, right? So they might want to see some movement in the right way before they want to buy, right? But the problem sometimes is most people use these orders to protect themselves. Okay. So the orders to protect themselves might be like, hey, you know what? I want to, guarantee myself a certain amount of profit, right, that I have on these shares that I own. So, maybe I set a stop order, right, to sell my shares at 20% of where the price is today. So, like, if potentially I'm at $100 a share in the stock, but I want to make sure that I at least make a certain amount of money. So I'll set a stop order starting at $80. Now, if it's a regular stop order, which means it's a market order, the moment it falls 20%, it sells.
Yep.
You sold at 80. Now, when that happens, are you watching? Right? Because if you're not watching and the market comes right back up, then you basically sold when the stock was down 20%, and then it just sat in cash and nothing happened afterwards,
Right.
right? Now that can be dangerous, right? People will think about that as a way of protecting themselves, right, Raymond? Like we see clients all the time. It's like, shouldn't I put some stop, and they call them stop loss orders, but like, shouldn't I put some stop loss orders to protect myself, right? And from a financial planning standpoint, from a long-term investment standpoint, the way I think about it is there a reason that if the market falls 20%, you would want to sell anyway? Mm-hmm. Right? Because if I'm trying to be long-term invested, and as many of you know who are watching, right, wouldn't you want to buy when things are low, right, and sell when things are high? But if you set a loss order, a stop loss order at minus 20%, you're selling when it's down 20%. So the assumption there is somehow that it would fall 50% so that you can buy back. But how close are you watching? Probably most people are not, right? Sitting in front of a computer trying to trade those differences. Okay. And so you have to be very careful in using these type of orders, right? To be able to understand, hey, like when I sell because I've set the stop loss order, I need to get back in and buy at some point. And if you're not aware, right, those price fluctuations can really kind of derail, how about that, your investment strategy. Okay.
Definitely.
And so we sometimes call that being stopped out. Like you basically, the stock falls and all of a sudden you've sold off and you're sitting on the sidelines now wondering how to get back in. So as we've always said and talked about to our client is like, while protecting yourself might sound good, you might end up hurting yourself in the long term, right? If you actually didn't really intend, if you still liked the company, you wanted to stay invested long term, right? There should be no reason why you're using a stop loss order just to try to capture those, right, price differences. It's very difficult unless you're day trading it, right, in my mind. Now, to add on to that, I wanted to tell you guys a couple situations where clients have done this, and they did it on ETFs. Like you can place ETFs, right, the exchange traded fund. You can place stop loss orders or stop limit orders where price becomes, right, the stop limit, again, is just an additional condition to say, once it hits this price, please make this limit order active, right, to be able to sell or buy. But I've had clients use these for ETFs. Now, think about it. If you're investing in an ETF, you're investing in a basket of something, right? And, you know, again, unless you're trying to day trade these price fluctuations, you're probably buying this ETF to be long-term invested. Right now, the clients in this case wanted to protect themselves from minor fluctuations, but they set the price. Even there's one situation a little while back, they set it at 20% off of what the current price was when they initially set it. Jeez. But what happened was there was like an overnight, just with that fund. Okay, I don't know what happened, but there was some overnight transactions that caused the fund to drop 25%. And then it popped back up like call it like half a day after it popped back up. Okay. Yeah. And what happened was this client had most of their funds in this one. And this was just like a broad market US exchange traded fund, nothing special. And it completely stopped them out at 25% down. Mm-hmm. It sold their fund and it was just sitting in cash. Worse off, they just weren't paying attention to it. Like they had set it and didn't realize that. They didn't remember that this was the case. Nor if you checked the stock ticker on a day-to-day basis, because it didn't close at that price, it just fell and came back up really quickly. You didn't even notice that it had fallen that much. And so they logged back in a month later, realized that, right, a big portion of what they had in the stock market was now in cash. Okay. And so that's the danger of setting these stop loss orders if you're not paying attention, right? And this, again, even in the most recent, right, like in the most recent like NASDAQ drop, I had a client where they set it too close. So like, and again, setting it in general, I think is questionable to think about, right? Like I don't know that in most cases aligns to a long-term investment strategy, but they set it at, I think like 10% down, right? For a growth stock. And it just right? NASDAQ plummeted, as we've talked about. It sold off, and I got an email for them asking me when I get back in because we have those stops, right? And so it actually kind of backfired in trying to protect their loss. They actually lost money, right? And so that's very key to remember about what you're actually trying to accomplish with your orders, right?
I mean, we talked so much about like the long-term investment and strategy, which of course we're fans of, especially with a lot of new investors, right, who might just be buying individual stocks where they have seen so much gains. Then it can make a little bit more sense in that case, right, where you have a stop loss order where you might have gained 300% in a week from that stock.
Yeah.
And you just want to take some gains off the table, right? You don't want to lose more than you have to. And maybe at the 10, 15%, you're still at above your gains, much farther than what you initially invested. So that stop loss order can make sense in that case if you're just trying to protect that quick gains that you received. And, it kind of goes back to what Alfred was mentioning, is more of a short term, trading between different stocks, individual stocks. Where it does require you to be more, eyes on the trigger there, right? In terms of making a trade there, but it does make sense in some cases like that.
It does. You're right. Like if the ability is to say, if it falls 50%, I'm good. I'm still capturing my 285% gain. But then now I can go ahead and redeploy that fairly quickly. It's about being aware, right? And then we talk about this with any topic that we talk about. Like the awareness is often very key about making the right decision. So if you're aware that you sold off, then at least you are aware that you have cash to buy back into the market, right? And so, and then maybe just a quick note here, right? Which is back to something that you might see in that little order blotter, I guess you can call it, but basically where in the website you're selecting how to make an order, there might be something that says, do you want to execute even if it's, like it might say like all or nothing, partially filled, something like that. What that is referring to is like if for whatever reason the volume of the stock, right, isn't very high and you're trying to buy or sell a lot of shares, then having a order that says, right, it has to be fully filled to execute, but the market doesn't have the appetite for it, meaning you're trying to sell 10,000 shares, but only someone is trying to take 5,000 shares at a certain price. If you select where it has to be fully filled to execute, then you're going to run into an issue. Even if the price hits, it won't take your order because it didn't have, right, 10,000 shares or enough buyers to buy 10,000 shares at that price. Okay. But if you select partially filled, right, they will fill as many shares as they can for you at a certain price, and while leaving the rest available, right? So that's another option that is in there.
Yeah.
Cool. Awesome. Did we miss any basic order types, Raymond, or did we cover it all?
No, I think we covered a lot of good information that I feel like people oftentimes get confused about and how best to utilize them. So hopefully with these details, it helps them paint a picture to their own situation and how to utilize them. Probably one thing I would add would be for the market orders. I know we touched on it briefly. It's the most basic trade, but there are times where clients place market orders after hours, right? So after for Pacific time. Just keep in mind that when you do place a market order after hours, it's going to get placed immediately when the market opens. And, a lot of times we've seen early on where the market opens, it tends to be very volatile, right? You might be seeing some rebounds throughout the day, but when it opens up, it might be volatile in one way or the other. It can work for you, it can work against you. But just keep in mind that if you do place it after 1 p.m. Pacific time or 4 p.m. Eastern time, it will get placed the morning when the market opens at that point.
Yep. Cool. Awesome. Well, thank you, Raymond, for closing us out on that. Right. Yeah. And so, for us, and these shows, we continually want to bring you content that allows you to learn a little bit more about your finances, how to manage it yourself. Feel free to give us some comments and feedback here in this comment section about what topics that you guys want to hear about. And again, as a reminder, right, we are always live here every Friday at 3 p.m. Pacific. And if you guys want to get notifications as we go live, make sure to hit the subscribe button. If you have any questions about us as planners or the service DiversiFi Capital provides, head over to diversificapital.com to learn more about it. And always, we want to make sure we're continually spreading the way that we can provide education. And a couple months ago, we launched our annual planner on Amazon, right? So we have our DeFi annual planner. Be sure to check that out, right? We had launched a quarterly version as well to help you take control of your finances yourself, right? A little bit of DIY financial planning. So don't forget that either. We'll include a link in our section or the comment section below. But thank you for joining us. Thank you for joining our show. And we'll be back live here next week at 3 p.m.
Awesome.
All right. Have a good one, Raymond.
Yeah, you too. Thank you,
See ya.
everybody.